need to make mention of the retailers, because we've
Yeah.
seen a host of retail results out of late, and the latest being Spar, where if you take out the BEE transaction, headline earnings per share up around 12%. We saw revenue growth of 9%. We had Wayne Hook in studio, and it looks like it really is a cutthroat environment, taking into account what Wayne was saying.
It is very tough out there. I mean, some retailers have come through with better than expected results, but nothing's been spectacular in our view, or more correctly, nothing still seems to justify the share prices. You know, the returns don't seem to justify the share prices, but that doesn't make any difference to overseas investors. They still love our retailers, and they're just buying it left, right, and centre. I mean, all the results have certainly been acceptable, no disaster. But when you consider what the ratings are, what the price earnings ratings of these shares are, they're very, very high. Unfortunately, we have been underweight this year in the sector, but we are certainly not going out and buying.
You're not going to change your view now?
No, not now, no.
Naspers also came out with a trading update
Yes.
yesterday, saying that its profits would be up 25 to 35%, and the stock rallied 5 3/4% yesterday.
That
It's
was
down 1%.
Yeah,
well,
but
we don't have closing numbers
Yeah,
yet.
but it's down a little bit today, but I mean, the whole market's down. Now look, those were also a very good set of results, slightly beating and market anticipation. Once again, a little bit of a distortion because of capital items and one-off treatments in the results, but it was still nevertheless a very, very good set of results. And it's certainly a share we like, and we've got lots of it.
Why did the market react so positively to it if we still saw the one-off items?
Yeah, the underlying trading results were better than was expected. There was a big boost to the domestic pay TV business, much more than what they thought because of the World Cup. That's come off a little bit now, but the actual underlying trading, ignore all the value of 10 cent, ignore all of these things, it was good. And of course, to help that, the 10 cent share price went up yesterday 3-4%. I can't quite remember.
So there was follow through from that.
It's off. The 10 cent share price is off. Well, it certainly was off this morning, but that also helped the share price go up strongly.
We also need to make mention of Ireland, because the international news flow has been dominated by Ireland. We haven't got the Irish government at this stage bowing down to pressure and taking a bailout, but it does look as though that pressure is mounting.
No, look, they're going to have to do it. And I mean, and I follow what Stephen Kosef said last night. He said they have got no option. They have to take this. They might not like it.
So there's no room for political pride here.
There's nothing. He said, if the market thinks you're going to take it, you had better take it. Otherwise, you will be in a way worse position, you know, than if you don't take it. So they will end up taking it.
Probably going to happen this weekend.
Oh, very easily. But of course, remember, I mean, two factors. When the first scares came out about European sovereign debt, Greece, we know all the stories, the pigs. The markets took a walloping. Now, when the same thing reoccurs somewhere else, market, quite frankly, is not all that interested. They're actually not all that interested in it. So, you know, it might fall.
We've got used to
it might
the bad
fall
news.
0.5%. No, you used to bad news. It might fall 0.5%, might fall 2%, but it's not going to collapse around your ears because of Ireland. The one mitigating factor is that the German economy is doing extremely well. So at
But
least
the big
they've
question
got the
is,
position.
can Germany save the rest of the Eurozone? I mean, is that a reality?
Well, it can't save the big countries. If Italy or Spain had to have a problem, there would be a problem. I mean, those are proper big economies.
But it can bail out the peripheral
the small ones,
economies.
Yeah, they're very, very small. I mean, I don't know the stats for Ireland, but I know that Greece was something like 2% of the European economy. So it was actually quite small. So the smaller ones, they can provide enough liquidity. But I mean, understand, the world's awash in liquidity. There's lots of money around. There's lots of bailout money around. The problem is consumers aren't spending it.
We also need to touch on China.
Yes.
And the fact that it does look as though an interest rate hike is imminent in that territory, and perhaps other creative methods of cooling down that economy, so to speak. Your thoughts? Because that's key for us in our commodity story.
It's key for us, but you know, maybe China is doing the right thing. They tightened bank reserves, was it last week? Can't quite remember. They tightened bank reserves, and it seems very, very likely that we'll see a hike in interest rates. They worried about inflation. Their inflation
came out at 4.4%. We knew we had to be cautious if it was over 4%.
Yeah. They came out and it was higher than expected. I think it's the highest in 3 years or 4 years or something like that. So they're taking a preemptive strike about it. But we understand, in China and in other emerging markets, it's not really so much the level of interest rates that's important or what gives them growth. is overall there's very little indebtedness in the system. So even at higher interest rates, they can still continue to grow their economy simply because they have got low debt levels, not like the rest of the world. So the difference between emerging markets and developed markets is actually people who are taking on debt versus people who are paying off too much debt. That's the actual distinction between the two. So China hiking bank reserves, China hiking interest rates will take some heat out of the market, but it doesn't destroy the commodity
Solid growth.
cycle.
I mean, third quarter growth was at 9.6%.
It doesn't destroy that.
The numbers.
And understand, no one actually wants China to slow down. No one, including the US, because they know that this is the one consumer body that can take up some of the slack. And I think this will last as long as global liquidity lasts, which is at least another year or two.
Wayne